What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is March 19th of 2020. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, we're not only going to be diving into cryptocurrency markets as we have a double-digit rally across the board with most plays up by 10% or more, but along with that, we also have to spend some time taking a look at a lot of data in regards to traditional markets, from taking a look at some of the major indices to also talking about some of the key signs that are showcasing we're going through a massive set of demand for the dollar across the global economy. And what that means not only for traditional equities and other assets, but what it means for cryptocurrencies. All right, so we've got a lot of things to discuss, guys. Let's go ahead and dive right into it. So taking a look across the board here, we can not only see some of the key leaders like Bitcoin and Ethereum tracing pretty much alongside one another at 13.4%, but we can see here a vast majority of cryptocurrencies doing well across the board here, many of which are in double-digit territory. And the interesting thing is we've got a lot of our plays doing well. Chainlink up 20% here, recovering a lot of the losses over the last week. We've got Engine Coin as well, up 50%. We've got Steem up 116%. So a lot of these plays doing very, very well, as well as Dash down here around 28% and Ren at 25%. Now Theta was a close one as well for our top 10 this year. Didn't make it, but they just got one of the actual projects that are actually being utilized by people, and actually has a pretty good use case in the sense of blockchain. But I want to go ahead here and talk a little bit about markets right now. I got us on the 1 hour here because so far we've seen exactly what we wanted to see here in the sense of higher lows and pressing up towards this key level of resistance. Right now we're seeing it looks like we're getting about $100 or $200 decline here from where we were at just a couple of moments ago, or about $150 to be fair. Testing up towards this key resistance level. The thing I've been really trying to press to people when it comes to my analysis here on Bitcoin in the short term, you guys know I usually don't like to think too much in the short term, but this is going to be a very important time period for Bitcoin, whether or not we go from, for example, 8 to 9,000, or if we start selling off again back down to new lows. And in this case, the basic thing I was talking about yesterday is I was generally seeing a lot of support here, but what I like to see after we start to formulate what might be a new low is I like to see it hold that range and to formulate a new uptrend line. That's exactly what we did. We came back down and tested on this after we had set this this standard low here. You can see that price comes back down, and when price can hold above there and start ticking upward, that's a sign of confidence. It means that bulls are all on the same page here in this case. They're looking at these levels, and some are already buying in this case. They're buying at a premium compared to people who are saying, oh, I'm going to wait down here till 4,800, or I'm going to wait here until 5,000 from the previous uptrend line. That's again a sign here in price without using any technical indicators, without overanalyzing the chart, just knowing the human psychology here and saying, oh, wait a minute, people are buying in at this level. And then what happens is it sparks a sense of FOMO here. It shows signs of confidence, and people start piling in this case. That's just how markets work a lot of the time. And this is relevant in equity markets. It's relevant in commodity markets. It's a signal of human reaction to price. So just take that away if you take anything away here in the sense of TA. Look for what price levels are showcasing, support and resistance. Think like a naked trader. You don't have to be naked. I'm just kidding, but it's the terminology is that you're a naked trader if you're focusing on just on support and resistance in this case. People overthink TA a lot of the time. What I can tell here in this price is that it tends to be that it gets resistance right here on a big even like 6,000. Big evens matter. In this case, we can see that there's consistency here. And in this case, it's likely setting up an ascending triangle, which is a bullish pattern, meaning that we'll likely break out to the upside. But again, who knows? It might not happen. We'll have to see. I'm going to wait until we get above 6,000 to be extremely confident. Now, next thing I wanted to talk about here was a lot of the decline on hash rate has happened over the last couple of weeks. There's been a pretty decent sized decline, over 30+% here from the peak of the hash rate we recorded here on March 5th. And in just a matter of about a little less than 2 weeks, we've dropped from 133 down to 97.9 here in the sense of Bitcoin's hash rate. Now again, in the sense of this decline, it's not really a big deal. It doesn't mean Bitcoin's network is really much less secure, right? If we take a look across the board here over the last few years, guys, we're still way up on Bitcoin's hash rate, okay? So in this case, right, we have so much power going into securing Bitcoin's network. To be fair here in this case, guys, this is not that stark of a decline, but it makes sense because over the last week, there have been a ton of miners who can't produce at these levels, especially with the difficulty that comes with this hash rate. So you have basically a lot of people competing right now, a lot of new mining operations opening up in the United States and other regions across the world, and now they're having to shut off their machines for a little while. And I honestly think, to be fair with you guys, I think we're going to get a pullback all the way down to this level here at around 100. Right, excuse me, not 100. I wanted to get the low range down here. I think that's around 80 hash. Yeah, right there. So basically around the 80 level here on the chart. I think that's going to be probably where we go to in the sense of just finding a good support level. But either way, still at that level, it's not a security flaw for Bitcoin in this case. There's still so much hash rate going into securing the network. This is just what happens when you have these cycles where prices get too low. Difficulty in this case drops because miners have to shut off their machines, and then it becomes attractive again for people to turn on their machines. This happens time and time again, but we can see here, generally speaking, mining hash rate is going up on the long term. And so long as that stays, then Bitcoin in this case is going to have a secure network. But again, just having the hash rate go up isn't also a sign for price to go up. Bear in mind that. Very important to understand. Now, I wanted to talk a little bit about some of the data science models. The 200-week moving average heat map, still holding on the 200-week moving average, just like we did back here, just over a longer extended period of time. Important to note here as well, a very similar difference in price, like an increase in price from the lows of the first contact with the 200-week to the second contact. If you take a look at the percentage change from that low price to the higher low in this case, similar to what we did over here, you'll see that the percentage change is actually not too different. So just over a longer period of time, that's the key difference. Along with that as well, we can take a look here at the 1-year HODL wave, which is a specific model focusing on the amount of Bitcoin that have been held for over a year in this case, and it uses the unspent transaction output model for Bitcoin to do so. Everything's public on chain. So we can see here that similar to where we were back here in 2015, we're holding around 59 to 60% of the entire Bitcoin supply for over a year in this case, or at least it hasn't moved on chain in this case, which is a very important thing to note. Now, bear in mind, the one thing I will say is that I would have liked to see this level higher than where it was back in 2016, right? I'd like to see this maybe around 64 or 65%. So we might have to get to that point in this case before we can be confident that this is really going to spark a new bull cycle, because it tends to be that when people hold a larger amount here and it's not circulating as much, that means there's less sell side demand, right? And you tend to see that it spikes up here at the HODL wave as the market goes down. And this showcases the difference in dynamic. It's much more favorable to purchase something at a low price, right? Not to mention as well, people will jump in, institutional investors pick up their demand as prices are down, and as less available supply is moving around, then you start to see prices go up. And then you have the halving event playing into role, which boosts the supply and demand balance even further off to, in this case, supplement the demand side, or excuse me, cut off the supply side, therefore making the demand side outweigh the supply side even more of available Bitcoin. And that's what leads to these spikes here, right? And you can see that people offset some of their Bitcoin holdings, they start moving and start selling it and trading it. And you can see in this case that up to the peak here, you tend to be close towards the bottom of the HODL wave. So very interesting thing to take into mind here. Now, last thing here I wanted to talk about is stock to flow model. Still generally on pace here, definitely on the lower band here for the stock to flow model. But I think as we go over the next few days, we're going to be getting a bump up in price. The data science models here are always a day or two behind. So in this case, we'll have to see what the reflections of the new price action are going to be over the next day or so. All right, so that's it in the sense of crypto markets. Diving a little bit into hash rate, some of the data science models. All in all, I expect a further decline in hash rate, and so far the data science models are showcasing us that the real next thing we have to worry about with Bitcoin is the halving event. Nothing too much to stress about. Now, I want to go ahead and talk a little bit about traditional markets and talk about how across the board, the global economy right now is seeking cash. That's going to be the big theme that I really propose here over the next couple of minutes here, really talking about through traditional markets. And this chart here demonstrates this, the sell-off in Bitcoin, the sell-off in gold, which is the black line here, and along with that as well, the sell-off in negative yielding bonds. This is the same chart we looked at a little while ago, but it has the updated valuation of these markets. And we can see here that Bitcoin has had about a 50% haircut. We've seen gold as well lose over 250 points. And along with that as well, we can see negative yielding bonds, though negative rates have not gone away and probably more bonds are negative yielding now. The value of those underlying bonds in this case have sold off to 11.7 trillion. So what does this tell us here? It tells us that people are rushing to cash here. They're rushing to cash for a lot of different reasons. first thing here that I wanted to talk about here, in oil markets, we've got a price war going on. And this is not only not faring well for a lot of U.S. oil manufacturers, but this is a time where a lot of these companies are over leveraged, clustered with debt in this case. And now, again, we're going to see the cheaper producing countries, the countries that can produce at a cheaper rate, they're going to push this price even further down from the 20-something dollars a barrel we're currently trading at. It's absolutely insane. So this is weighing on the economy here. And again, making a lot of companies insolvent, basically setting a precedent demand for cash. But the biggest one is the sell-off in equities and the broader risk-off narrative that's been building in traditional equities. And the interesting thing here as to what makes me a little bit concerned over the next couple of months is that this isn't like history here, right? You can see here historically that if we take a look here at the S&P 500, we have these periods where we push sideways. We have a consistent resistance range, and then we go into a secular bull market where we always hold above the 200 week until we start going towards that neutral period and start hitting consistent resistance, right? And we can see over here, holding on the 200 week throughout the secular bull market, hitting consistent resistance. And then here, 2014, I think it was around 2013, 2014, we broke past the previous highs and continued on to a new secular bull market. And the theory would be that we would hold here and move higher, but in this case, we dipped quite steadily below and quite early on in the new secular bull market. So what this shows us here is that this might be a big break on history, much like how Bitcoin broke the logarithmic chart recently. We just recently broke a significant support level for the S&P 500 during this stark correction, this most stark correction we've ever had in the sense of time period ever in the S&P 500 and the Dow Jones, faster than 1929, but not as severe as 1929, not yet. That's the key thing to keep in mind. You can really see that here on the chart here. The dip here really signifies the significance of it. And here's a correlation to 1987, Black Monday in this case, where equities sold off at a dramatic pace, having the worst day in the S&P 500 and the Dow Jones history. We just recently had the second worst day. So again, signifying the similarities here and the severity of the sell-off to 1987 in this case. So again, very important to see just how bad this market has been. And we can see here as well, global equities and bear market. Now, again, it's going to make sense when I'm talking about these charts, guys. I'm not just trying to make you bearish on equities. It all come together in just a second. We can see here, for example, the MSCI here in this case, the ACWI in this case, the MSCI in this case is measuring a lot of broad markets here. But you can generally see the percentage of countries now that are at least 20% off their 52-week high, meaning taking the broader indexes of these countries for their equities and seeing, where stocks are right now. So as the indices basically measure the broad performance of a market in this case, if we're seeing that over nearly 65-70% are 20% or more away from their 52-week high, this signals that most stocks across the board have sold off more than 20%, if not worse, So that's the thing to take into mind here. You can take a look at all the major indices across the globe, not just the United States, to the Dow Jones, or the S&P 500, or the NASDAQ. All of them are down. Right? They're down very, very severely. Now, there's a new path, supposedly, that Goldman Sachs has put together here where they believe that there's another 3 months of downside down to 2,000 in the S&P 500. And then by the year end, due to a resolution possibly of coronavirus or COVID-19, that we're going to make a stark rebound of over 50%. I have to say, I do not believe the economic ramifications of this can easily push up equities this high unless the Fed just starts printing money like crazy. And if you were to inflation adjust the chart, the return would be somewhere down here rather than where they're pointing here, right? It might look like it's going to 3,200, but you have to consider the debasement of the dollar in this case. Now, last thing I want to talk about here before we really get to my point here about dollar demand in this case, the key thing I wanted to talk about is the general decline in stock buybacks. We now have Q4 figures, guys. It's around, in this case, a little bit under $180 billion compared to where we were rocking around $200 billion per quarter back here throughout most of 2018. So the decline is very clear. You can see the MSCI World Index showing here, again, a flattening curve turning over here. In this case, in my opinion, from my understanding, in this case, participating constituents referring to the amount of companies doing stock buybacks. And in this case, we can see just like in 2006 and 2007, a precursor here to the inevitable recession in 2008. So we have a lot of banks now who are committing to not doing stock buybacks. This alone right here is why I'm bearish on equity markets. But the thing I want to talk about is the rush to cash. Why is it that I believe that there's a rush to cash right now? And why is it that there are a lot of other people saying the exact same thing? Many people who've been talking about it for a very long time. The reason is because if you think about every single asset being sold off right now, right? There's a general need for cash. But when you're selling equities, when you're selling commodities, when you're selling Bitcoin, when you're selling anything that trades to a dollar pair, you're essentially taking a long position on the dollar. If you think about it, right, you're going along with the dollar. You're purchasing dollars in a sense. You're exchanging some form of asset like you would trading an apple for an orange. Think about the apple as U.S. dollars and the orange as a stock, right? If I have oranges and I'm exchanging it for the apple, I'm hoping that that apple is going to retain some form of purchasing power, some form of value. And I know it doesn't make sense to a lot of people because many people are like, oh, the Fed just prints dollars, Nick. They're worthless. They're pieces of paper. You can't build a home with them, yada, yada, whatever. The dollar is the world reserve currency. And in times of fear, people want to get their money out of assets that have probably had some of their best yields in history. Right? We had the longest economic expansion in equities, and also during a time of fear. Right? When you have this compounding fear that's been building up, you have a lot of people who need to get out of positions. They need to cover themselves and take profits, if not take their losses. That's another factor you have to consider as well. So as there's this big rush to cash, we can see it being reflected in Forex markets. So what we're taking a look at right now is the US dollar currency index, or the DXY. We take a look at this inside of my newsletter a lot on the channel. And we can see here that over the last 2 weeks, there's been a huge rebound in the dollar. After a relatively decent sell-off, again, the VIX was getting, the DXY was getting very volatile here, having these multi-week rallies to the upside or downside where the dollar gained strength, it lost strength, and then we came rebounding out of it to new highs for the year here that we haven't seen since back here in March of 2017. And I think that this might very well continue. A lot of people who I admire, like Raoul Paul, a lot of people out there believe that this is going to actually happen, that this is going to continue to grow, this long dollar position. And you can see it in the charts, guys. For example, last couple of days against the Japanese yen, dollar went from a rate of 101 Japanese yen per dollar all the way up to 109, pushing towards 110 Japanese yen per dollar. We can take a look as well, Euro USD. Right? Now, in this case, the euro is declining to the dollar, right? It depends on the base pair here. We're saying that for every euro can only buy $1.07 versus a little less than, 2 weeks ago, right? That it basically traded at where you could get $1.14 per every euro, right? So you could also flip the chart if you want, but Euro USD is the standard pair people take a look at, as well as USD GBP in this case. So you can see here a massive leap up here in the dollar, right? The dollar now can buy a fraction more of the Great British Pound than it could before, right? So originally you could buy 75 cents worth of Great British Pound, and now it's up to 86 in this case, right? So you see this big leap up here, and it's almost kind of squeeze and major demand for dollars, where people are just filling up the book here to get dollar exposure, right? So this signifies here that people are looking for a hedge, right? As the global economy hits into a slump, and a lot of people are covering positions, people want to get into the best single currency that can provide protection for them. And I only want to take a look. There's even worse ones, guys, like AUD, USD, for example, the Australian dollar. Take a look at how the Australian dollar is failing. Guys, it went from 70 in this case down to 58. This is going to get to the point here. It did trade around here at 55. You can see this morning it was pretty low here. But to a point where it's going to be, you could get 2 Australian dollars for 1 US dollar. And that was like unheard of a couple of years ago when the Australian dollar used to be more valuable than the US dollar. That means the purchasing power of Australian citizens has gone down in half comparative to the dollar. It's the significance here of the long-term trends in currency markets. And again, it signifies the importance of where people are looking to get into dollar positions right now, and then they're probably going to be looking somewhat to their dollar positions to put their money in hedges, things that perform well during bear markets or fearful times. And what do you think is going to be doing well during that time, guys? I'm really interested to hear what you guys think. I think personally, it's going to be what we've been looking at for a while, gold, silver, and Bitcoin. But right now, we can't see that hedge play really come into effect until we have the cash squeeze, until people finally close out their necessary positions and then they reallocate their portfolio. In this case, I think Bitcoin is going to be doing quite well over the next coming months. I'm not fearful at these levels. I don't have any reason to be fearful. All in all, guys, right? In this case, we broke out of the logarithmic chart here. But I think in this case, we're going to make a quick rebound here in crypto markets. And we're going to be testing around, not here on the logarithmic chart. I don't know why it keeps putting my logarithmic lines here. I adjusted it to the just general kind of spot normal standard chart. In this case, I think that we're going to be bouncing around sideways for a couple of months until the halving comes in. And there's a lot of great ways where you guys can get exposure to cryptocurrency markets. One of them is our sponsor, eToro. Now, for those of you who haven't bought any crypto positions or might just want to look to get a little bit of exposure elsewhere in crypto markets, why not try eToro? In this case, eToro allows you to buy a wide range of cryptocurrencies, and you can add them to your portfolio. Along with that as well, utilize their copy trader feature where you can trade alongside a variety of different traders real time at the exact same prices. So if you guys are interested in that, check out the link down below in the description. But all in all, guys, that's going to be it for today's video. If you guys like this video, please drop a like. It's always appreciated. And if you're new to the channel, hit the bell icon, subscribe. We always love having new people join the family. But if you've got something to say on the things that we talked about today, please feel free to leave a comment down below. What do you guys think about this topic of Forex markets? Are you guys interested in me maybe talking a little bit more about this and discussing the kind of dynamics of the Forex market? The reason I tend to avoid it is there's a lot of scammy people in the Forex space. It's fun. You guys think crypto can be bad sometimes. Forex is like 2 or 3 times worse. And the reason why is because there's just a whole ecosystem of people and traders who fluff themselves up as being great traders in Forex when it's one of the most difficult markets to trade. Right? It's very difficult to get a sense of transparency on how people are performing in Forex markets. And people, make all these videos, I'm in Cancun or something, and you probably see it on Instagram and stuff like that. Don't buy it. Forex is not, anyone who's making money in Forex is not going to Cancun. They're sitting in their home, in a dark room, doing very basic support and resistance, technical analysis on long-term time frames, and trading with decent margin. That's the general case of those who succeed. Anyways, hope you all are doing well wherever you are. Hope you guys are having a great day, and I'll see you all in the next video. Stay tuned.